Lightspeed stock, or LSPD stock, is the topic of today's presentation. And the reason that we're covering Lightspeed Commerce is because the people who pay our bills asked us to. So lots of times we'll see companies being requested in the comments section of our videos, but where we'd like to see those raised is on our Discord server. That ensures that the people requesting them have opened up their wallets and financially support us. So when somebody raises a company that we may want to take a look at, what we'll do is we'll vet it briefly, and if it merits a further look, then we'll throw it into our research queue, and an analyst will take a closer look at it. If it seems like something that we'd potentially cover, then we'll add a poll, and you can see polls here on our Discord server where people are voting on them. At the top there you see, would you be interested in seeing us cover Lightspeed? Well, 22 people voted yes and 15 people voted no. So what we do is we wait until a poll gets a sufficient number of votes, let's say 25 or 30. The number will grow as we increase the participation in these polls, and then if enough people vote yes, we'll cover it. So that's why we're covering Lightspeed. Now, here at Nanalyze, we're covering over 460 tech stocks and about 80 dividend growth stocks. We're not looking for new names to cover. There are plenty of quality companies out there. You don't need to search for them. So people always respond to that, say, well, which ones, Joe? Well, that's what we do here at Nanalyze, and we have to save something for our paying subscribers. So the 37 tech stocks we've invested in and the 30 dividend growth stocks we've invested in are available to people who subscribe to Nanalyze Premium. Now, when we look at new companies, we take what's called a hiring manager approach. I worked as a hiring manager at an officer level for a large multinational firm for over a decade, and I learned that when you vet a series of candidates for a particular position, that it's a given they're coming to the table with a great CV and that their supposed track record on paper is phenomenal. So the approach that you can take to effectively dwindle down the resume stack is to look for red flags. So that's the approach we take when we're looking at new companies. We look at Lightspeed. First of all, the market cap here is well above our $1 billion cutoff, so that's great. But here on the 5-year chart, and I'll usually go when I look at a new company very quickly to see what sort of historical price action there's been, and I'm looking for things like pumps or hype events. And here you can see a major event caused a sustained share price decline, it looks like in late 2021. So we'll want to take a look and see what that was all about. Now, when I dig into Lightspeed a bit, I came across this slide in one of their presentations that says ideal customers and cohorts. So we can see here that they're involved in retail and restaurants, and you can see the point of sale system there and some screens and whatnot. So we start to get an idea of what they do. And then when we see customer locations here in the middle, we can see that the amount of money, the transaction volume for these different types of clients fall into these buckets, and they say here customer locations with GTV of over $500,000 a year have a lower risk of churn and higher lifetime value for Lightspeed compared to lower GTV per year customers. Indeed, so when you're selling a solution to businesses, the bigger the business, the more likely that you're able to generate a significant amount of revenue, and when you start servicing lots of small clients, that turns into a support nightmare. Now, the first thing I thought of when I looked at this slide was Square's slide, which you can see here. Look how similar they are. So Square for retail, Square for restaurants. We've written about Square on numerous occasions, and when we look at what Square offers, it starts to mimic Lightspeed quite a bit, and it's more likely that Lightspeed is mimicking Square because Square is significantly larger than Lightspeed. Now, one big difference between these two companies is when you look at, you start to look at how Lightspeed makes their money. You see they have subscriptions, transaction-based. That's great because then they get a little cut of the money that's flowing through their platform, and then that presumably will grow over time as usage increases. But this hardware component is very concerning. Look here that in 2022, they had the cost of revenues for hardware was greater than what they received for selling that hardware. So that tells you that since they're a reseller, they're actually buying hardware from other companies and selling it to clients for less than it costs them to purchase. So they're losing money on that. And then if you look to the left there, you see for 2023 that the hardware sales have gone down, but the cost of hardware has gone up. So they're giving away even more of it. And that's a problem if they're doing that with hardware that they're purchasing from somebody else. Compare that to Square that's developed their own hardware. So for Square to give it away, it's a lot more cost effective than for Lightspeed to buy hardware from somebody else and give it away. Now, I'm going to take a break from this just for a second and point you to the join and subscribe feature. So if you're watching this video for the first time, please click subscribe. Subscribe to our channel. I can promise you that you'll become a better investor as a result of doing that. For those of you that have watched us for a while and laud the sort of content that we're producing in the comments section quite often, we appreciate your support. One way that you can help us is if you click that join button there. There's 2 tiers. For $1 a month, which is nothing, you can help support us financially. For $5 a month, you can join that Discord server that I talked about in next week's live 10K review, where myself and Wyatt are going to go over a company that was raised on our Discord server. Soon, those will only be available for commenting for those people that have joined the channel here. So let's get back into talking about Lightspeed. One problem that we had right away was that the industries Lightspeed operates in are some of the riskiest industries when it comes to being affected by a recession. So you see here, retail, restaurants, hotels, and real estate, some of the businesses often hurt during a recession. Such services may enhance our quality of life. They're not necessary to maintain our basic standard of living. So in the past, we've looked at SaaS companies dabbling in construction like Procore and restaurants like Toast, and we passed on those for 2 reasons. One, that they're not industry agnostic, so they're only confined to those verticals, which means that if there's a recession, they're going to take a huge hit. And both industries, construction and restaurants, happen to be not resilient to recessions. So that was a concern. Now, the other concerns that we found around Lightspeed, so in investigating why they saw that share price drop, I'll usually start digging, and I came across this short report by Spruce Point on Lightspeed. Now, you need to take these with a grain of salt because the individuals putting these out are incented to speak negatively about these companies. You can see here they talk about Lightspeed overstating its customer account. Well, I don't really care about that. And GTV by 10%, oh, whoopee-doo. Evidence of declining organic growth and business deterioration. So that's a bit of a concern there. If they're running into some competitive pressures from the large companies they're trying to compete against, like Square, and then this bit here on their recent acquisition spree has come at escalating costs. So that's interesting to dig into that a little bit. Now, I popped open this short report and just glanced through it. I thought this slide was interesting. They say, we believe Lightspeed is a poor man's Shopify. So Shopify is another competitor of theirs, a very formidable one. So that's a concern, and you can see here they're pointing out that Lightspeed had the point-of-sale hardware first and then moving into e-commerce with that. Well, they're claiming that Shopify's easier path is to have the e-commerce component first and then move into point-of-sale. Maybe it's debatable, right? But it's interesting now that we know there are 2 large competitors, and here they've pointed out that Shopify recently added this migration section. These are always great on a company's website to see who their competitors are so that you could see Shopify's all their main competitors here listed out, and they are helping their future clients migrate from a competitor over to Shopify. You see they added Lightspeed there. So that's interesting. And then this slide in the short report, presuming that this data is accurate, shows the acquisitions that have been made over the years, and they say here that they've cobbled together a motley collection of assets at increasingly expensive valuations, and that's in fact true. And when we start to dig into the financials here, what you can see is the table on the lower left here. See that goodwill? That's a lot of goodwill considering the size of Lightspeed, and you can see that it's dropped significantly. That's because they had a huge write-down of goodwill, probably won't be the last. And that shows you that indeed the acquisitions they were making they were paying too much money for whatever they acquired. Here you can see their cash position is around $800 million, and the cash flows on top. So what, they're burning $120 million a year. They got $800 million in cash. So they're not in any danger of going away. You can see the revenue growth on the right. That seems to be steadily growing there. Now, we don't know how much of that is organic and how much of that is attributed to acquisition. That would be a next step here. Now, in case you can't tell, this is a company already that we've seen enough red flags that we're not really interested. In particular, the fact they're competing against Shopify and Square. When we look to invest in a particular theme, we go right to the leaders. We don't muck around with the up-and-comers. So just some questions for investors in this company or people looking at it. What's your bull thesis here? So if it's company specific, did you work there? You know someone that works there? You use their product? What do you think is special about their offering and how they're going to outcompete much larger competitors? If you're bullish on technology adoption in retail or hospitality, that's understandable. Well, then go invest in companies that are leaders in that space. Bullish on Canadian tech firms. We'll talk about that in a second. You may see an attractive valuation. That's debatable. So their simple valuation ratio, which is market cap divided by annualized revenues, that's 2.5. That's not overvalued compared to our catalog average of 5. But if you compare that to Square, it is, though Shopify is rather rich at 12. What seems to be the case here is that you heard a bunch of people talking about this company, and now it's on your radar. Now, when we look at Canadian firms, this sort of gravitation towards a particular company seems to happen a lot in the markets that I've highlighted here, the UK, Canada, and Australia. And all the time that I've been doing this and researching companies, I've never seen good things come out of these developed markets that investors often look for to try to find diamonds in the rough. In fact, all that I can recall are just bad stories. And this is a weighting breakdown of MSCI World, so that's all the developed markets. Well, actually, this has emerging markets in it as well. Those are in pink, developed in blue. So this would be a breakdown of MSCI ACWI, which is All Country World Index. You see that close to 60% of the equities in the world are located in the United States. That's where people mainly invest. Then you start going down this list here. But what I've found historically is that when you start looking at AIM or TSE in Canada or the ASX in Australia, that the names that you'll find there are trading at a discount, which is a good thing because typically they don't have the same liquidity as you'll see in companies that trade in the U.S. Though, of course, Lightspeed is an ADR. It trades in both countries, U.S. and Canada. But what you'll also see is technology companies that don't really go anywhere typically, or that are being outcompeted by much larger players. So a second option for investors here, if you're bullish on retail and restaurants, look at Vertical Solution Toast. If you're bullish on digital transformation for smaller businesses, then you buy equal parts of Shopify for the e-commerce component and Square for the point-of-sale component. Just buy a basket of these stocks, reduce your company-specific risk, and call it a day. So just some parting thoughts here. Some of the interest, I think, in people wanting to hear what we think about stocks are because they're heavily discussed or they're controversial or sometimes they're absolute shite, and people will want to hear what we have to say about that because there's a humorous element to it, I suppose. But Lightspeed isn't a bad company. It was probably heavily discussed. That's where all the interest came from. It isn't so obvious what they do on the tin, so it required a bit of digging. And after digging in a bit, I can see that this is certainly something that we wouldn't consider investing in. These stocks that trade natively on these other exchanges aren't typically compelling, as I said, though they often generate large fan bases. So you can join us on Discord and have a say as to what stocks that we're going to cover next. Just to conclude, you don't need to go searching for great stocks. I see this all the time, retail investors seeming like trying to find some diamond in the rough. There's tons of great companies out there. You don't need to look for them. Canadian exchanges haven't been a place we've seen many great tech companies emerge from. Contrast that to Israel, where a massive number of great companies come out and end up trading in the United States eventually. Now, we're not bullish on retail, hospitality, or travel as a rule. We never have been. look at Dividend Champions to see how many retail or hospitality or travel firms are in there. Somebody described, I think this was Square, described a competitor as a disjointed M&A roll-up, and it seems as if they were talking about Lightspeed. I probably agree with that description. There are better options than Lightspeed to get similar exposure. So I'm going to put up another video here for you to watch. Before you watch that, please click the Nanalyze logo on the right, subscribe to our channel, consider joining and supporting us financially. Thanks so much for taking the time to watch this today.